makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. Also, happy Monday. I'm Francine Lacqua here in London with the conversations that matter, and here is what coming up on today's program. Rising concerns over China's recovery as the crisis deepens at property developer Country Garden, plus alarm bells ring in the country's shadow banking sector. Goldman predicts the Fed will start lowering interest rates by the end of next June with a gradually quarterly pace of reductions from there on. Plus, the yen weakens through a key level against the dollar, hitting a 9-month low as traders watch for any signs of intervention by officials in Tokyo. So let's take a look at the European markets map. This is what markets are telling us across the board. So you see there's a bit of a tentativeness out there in Europe, but really the big story is on Treasury yields. So let's get up to those. They're edging up towards levels last seen in November. Again, this is on speculation that the Federal Reserve will keep interest rates in restrictive territory and disappoint investors hoping for easier policy. Let me remind you that later this week, the focus will be on the minutes, also from the Fed's latest policy meeting. As always, traders will try and figure out clues on the central bank's next move. Then the other key story, and it's actually our big number for today, is the level of yen. This is something that we've been focusing on quite a lot. It's now steady after breaching its year-high level of 145.07 versus the dollar. Again, investors starting to monitor that level for any signs that the government may intervene, as it did last year. Then we, of course, spend a big amount of time today talking about China. Shares of Country Garden closed sharply lower in Hong Kong after it halted trading of some of its bonds just half an hour ago. The developer also said it's now looking to pay maturing yuan bonds that are due on September 2nd over a 3-year period. The looming crisis in the Chinese property sector is weighing down the country's economic recovery. In fact, investors are also watching for official figures due tomorrow on industrial output, retail sales, and fixed asset investment. So let's bring in our panel of experts to talk China. Patrick Armstrong, Chief Investment Officer at Plurimi Wealth, and Bloomberg's Sofia Orta-Acosta, who for many years lived in Asia. So thank you both for joining us. Sofia, I feel like every day there's concerning news about China. And if you look at the evidence, there's nothing really to point to a better trend.
Yes, exactly, Francine. And the problem is there's a crisis of confidence, and that's the one thing that Beijing can't seem to solve. Last week, we had confirmation that China's in deflation. Now we have the property market again resurfacing risks, not just in the property market itself. You mentioned Country Garden in the intro, but also for the broader financial industry. I mean, if you look at the trust fund industry, many people don't actually understand what that is, but it's a huge amount of capital. It's essentially what China does. These trust funds pool household wealth. It's about $3 billion in size, and then invest in riskier assets to kind of generate high yield returns. So the fact that you have this crisis of confidence in onshore China is really rippling through the market, and that's not going to help with tomorrow's data either.
So, Patrick, do you think it's much worse than we were expecting, or we're just optimistic because they suddenly reopened after COVID and we thought it would follow the template of here in Europe or the US?
That's what I thought. In January, I actually actively changed my portfolio to position from a reopening of China, and it has been a string of disappointments since February. So you've got issues with credit, you've got issues with property, and that flows through into consumer confidence. And yeah, it's been month after month of misses and negative news.
But is this because there are structural problems that we hadn't really quite seen that were maybe masked because of COVID?
I think that's fair to say, and China tightened with everyone else, and now they're actively loosening, trying to stimulate the economy. And it's hard to put your finger on what's really driving it, but it comes back to credit, property, and consumer confidence, I think.
Sofia, I mean, markets have been expecting, right, policymakers to do something in China, and it hasn't quite been the bazooka that they were expecting. Is because that's limited in terms of scope and what it can do, or because they just don't want to yet?
It's both, really. You know, and I think the credit data last week, I was on holiday, so I was just checking it on my phone. Oh no, another set of bad data out of China. You know, banks are they're trying to extend credit. Credit is incredibly cheap. The central bank has reduced interest rates. They're unlikely to do so tomorrow. It's a monthly operation where it has the window to do so because it's already so cheap and nobody wants credit. I mean, it's the issue that Patrick's talking about. There's the demand issue is really, really acute right now in China, and everything that policymakers policymakers can do or want to do or willing to do has to do with the supply side when it comes to stimulus. And that's really the issue here. The policy transmission is not working. You have a confidence crisis. You have the property market where the majority of household wealth is still invested in the property market. So you're unlikely to get people spending. You have an enormous amount of savings that are not being deployed. I'd like to ask Patrick, when you're looking kind of outside from the region, from here, and you're looking for evidence that China's economic recovery is working, which data point do you look at?
I don't think you can find that data point. The one area I'm reasonably confident in is Macau and the gaming revenues, all of that. So traveling in mainland China out to Macau again, gaming revenues looks good. But overall, for the aggregate economy, I don't think there's something you can put your finger on because it's not there.
So, Patrick, what does it mean for how are you invested in China right now? Did you cut your exposure or are you waiting a bit longer?
I don't have much exposure. I do have two equities. I've got Alibaba and I've got Las Vegas Sands, which is the play on Macau. So I don't have a significant exposure. It's something that I'm not actively looking to add. I'm short China Vanke, which is a Hong Kong property developer, real estate marketer. But yeah, I've got some longs offset by some shorts, and I'm pretty comfortable right there.
Is there anything that's looking good in the Chinese economy? A sector that's being either supported? I know we have serious concerns about shadow banking, but frankly, that's not something that's only a worry in China.
Yeah, exactly. I mean, and shadow banking has been a worry in China for a number of years. I mean, I do think, when sentiment is this bad, and when there's this kind of crisis of confidence, that does keep. It tends to spiral downwards very, very quickly. You saw the reaction in markets today. I mean, European markets are fine, right? Nobody's kind of expecting China to collapse. So the crisis of confidence, I think, is very localized right now, which is a positive. People were panicking a little bit more about that globally at the start of the year. So I think that's the positive story there. But again, China has a lot of tools at its disposal. It's just choosing not to use them. And I think a lot of people forget also that the property crisis was engineered by Beijing. This is something that China needed to do to diffuse risks in the financial system. It's perhaps not working, or it's more severe than policymakers had expected, and you're not seeing that recovery story come through. But things will take time. Things in China take a lot more time. So I think, when confidence is this low, the risk of upside news is very, very high.
Patrick, what does this mean for the rest of global markets? So you could be importing deflation, which is probably welcome from central banks, or it could upend everything.
It's a bit of both. Basically, if you look at PPI surveys, basically manufactured goods coming out of China aren't rising in prices anymore. China's still probably going to grow at 4% this year, so it's still going to outstrip the developed world, but that's probably well below what the 6% people were looking for earlier in the year. So it's like the rest of the world, where things aren't completely terrible, but they're not good either.
But who would actually lose the most? Europe?
Europe and America still are big importers from China, but their economies aren't particularly strong. Consumers relatively robust, but you have seen lessening purchasing power in the West as well, and that impacts China as well on the manufacturing and on the demand side of things. I don't think there's much benefit, but there's not a massive collapse you have to be worried about unless you are exposed to Chinese property, in my opinion.
Patrick, does it change your exposure to some of the industries? We've talked a lot about luxury. But also some of the other things that, maybe are less immune to other sectors because of the China exposure. Yeah,
so I own Hermes. At the start of the year, I owned LVMH and Hermes. We've sold LVMH now. And the weakness in demand there has really been driven by the U.S. much more than China. The high-end affluent consumer still has a lot of purchasing power. They're traveling, so they're still purchasing the high-end goods. But it's actually the U.S. high-end consumer that's probably a bit of a headwind for that sector.
And Sophia, if you look at commodities and some of the things that we normally associate with China, are they still building and are they still using infrastructure, or do you worry about Australia and some of the commodities that are exported to China?
Yeah, I think the commodities market was, like many of us, like Patrick was saying, expecting that kind of reopening boost. So it kind of front ran that reopening boost that we never got, the pickup in demand within China, and the expectation that China, after that, when demand didn't come through, that China would kind of throw stimulus at its economy, and that would come in the form of infrastructure spending, building roads, building bridges, the kind of old playbook of Beijing. That's also not coming through. So I think the risk there is, not just Chinese demand, but global demand is weakening, and you're not going to get the kind of pickup in building and infrastructure that we've seen in the past. So there are headwinds to the commodities market there. But, you know, has that been priced in? I think much of it has. It's been a really kind of whirlwind year of trading for any kind of China demand exposed market. You know, the luxury industry was also a major way to play that story, because I think people like Patrick, and correct me if I'm wrong, don't really want to have direct exposure to China and prefer to kind of play it through other sectors. So
yeah, it's also quite hard actually, unless you're fully invested in China. Thank you both for joining us. Bloomberg Sophia Orteg-Costa and Patrick Armstrong, Chief Investment Officer at Plurimi Wealth, stays with us. Now, there is one stock we also need to watch out for. That's U.S. Steel. It's begun a formal review of strategic alternatives after receiving multiple unsolicited proposals. Now, we also understand that actually in the last day or so, United Steel has rejected a takeover offer from Cleveland-Cliffs, but the offer represented a 43% premium to steelmakers' last close, which is why we're now seeing a big bump pre-market, gaining some 22% for U.S. Steel. We'll have plenty more, of course, on this company and others. Coming up, Goldman Sachs economists also anticipate the Federal Reserve will start lowering interest rates by the end of June. We'll discuss that next, and this is Bloomberg.
Tuesday, in his first international media interview since becoming Taiwan's vice president, Lai Ching-te speaks to Bloomberg exclusively about his presidential run and managing relations with the U.S. and China.
Taiwan security is a global issue, and the peace in the Indo-Pacific region benefit all the countries.
What kind of leader would he be? What are his plans for Taiwan? And what would they mean for the world? Tune in all day August 15th, only on Bloomberg, your global business authority.
The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now, we also had breaking news this morning about the Agnelli family holding company called Exor buying a 15% stake in Philips for around $2.8 billion. Now, we understand what they're most interested in is actually some of the healthcare things that Philips does. And you can see that stock price getting some 4.6%. Now, for more on this, we're with Patrick Armstrong. He's Chief Investment Officer at Plurimi. Patrick, thank you so much for sticking around. Now, when you look, of course, at some of these, the stocks that are being, seen as attractive, like Philips is a bit of a jumble in terms of exactly what it does. Do you like healthcare?
The healthcare part of Philips, you can see that's what's attractive. So from their last earnings statements, their healthcare bit of the business was growing double digits, I think 12% from memory, while the overall business was growing at 3%. So a focus on the higher growth, higher margin, moving away from consumer electronics probably does lead into a higher multiple that would be warranted if it does shift focus in that direction, and that does sound like the plan.
Patrick, in general with these things, again, Philips has seen significant pressure because of some of the valuations and, investors testing some of the limits there. With someone like Exor that has quite a good reputation making good investments, I don't know whether you'd call them the Warren Buffett of Europe, but does it change the fortunes of a company like this?
It's a vote of confidence anyway. It's investors who don't have time to do deep due diligence are trusting that Exor has done the job for them. They see value and probably going to prompt extracting some of that value by helping management refocus on moving away from commoditized goods where you can't demand a significant profit margin into something where Philips probably can demand a significant profit margin.
I know, again, and there's still many concerns about, the costly recall of some of the sleep apnea devices, but do you own Philips?
I don't have any position on it.
Is there anything in that kind of space that you like, or again, it seems a bit more risky because it depends on trials and you just
I don't have any medical equipment companies right now. Valuation is much higher for the Thermo Fishers, those kind of stocks in America. So I think that's what Philips will be envisaging that they'll be able to get towards. But I've got more pharmaceuticals in the healthcare companies. I like the cash flow and the multiples they trade at, whereas the medical equipment companies are a little bit rich for me.
Okay, I have my morning must-read, Patrick, and only you can answer this because it's a fun but also actually quite sad read. It's by Andrea Felsted. She writes great pieces, usually on luxury, and today she asks, look, puppies and Patek Philippe have had it tough since COVID, and she says, look, both were highly sought after during lockdown. Demand has not recovered in the post-pandemic economy. So I'm not asking you whether you'd buy a puppy or a Patek, because I'm sure you'd buy both. But Patrick, are we underestimating when you look at travel and some of these, big impulse buying? Is it still a legacy of COVID? Do you trust the economy we're living through now?
Actually, at the start of the year, I love luxury companies because I didn't trust the economy. I didn't trust the mass market consumer. But that's actually been one area of resilience, that you've got a fully employed consumer in the US, pretty fully employed in Europe, and the spending power there has been pretty resilient. So I was trying to hide away from the mass market, move into the high end. And I don't think the high end is incredibly disappointed. I think it is definitely showing signs of softening. But mass market consumption's been pretty reasonable, and that's why I've lightened up on my luxury companies. But as I said, I still own Hermes.
Anything in pets?
I've got a company called Zoetis, which is a healthcare company, but it's healthcare for animals. So it does livestock, but it does pet insurance, it does dog and cat medicines and treatments, and that's going from strength to strength, particularly on the pet side of the business. So people are taking care of their pets.
Okay, I'm like your customer. I basically bought Peak Market, my puppy, but he's worth every single penny. We have to talk more about Andrea Feltzer's piece. Just read it because it's fun, but also a little bit sad actually for some of the pets to just go onto OPIN, go on your Bloomberg terminal. And good news, maybe for Patrick and others, the UK pet market has stabilized. We can't only talk about puppies and nice watches. The Fed, are you expecting cuts next year?
It's too hard to say until something shocks the employment situation, and it's not going to be Fed hikes anymore. So maybe the lagged impact of the Fed hikes provokes a recession and pick up in unemployment. Okay. And the Fed's forecasts actually say they do expect unemployment to rise, but they actually expect continued economics. Well, I don't even know if I want to call it strength, but no recession anyway. So I'm not sure when the cuts will happen. I don't think there's going to be another hike, and I think the Fed may be sitting on its hands for a very long time. They've acknowledged that they are in restrictive territory already. Yeah. So if you do see inflation getting down to their targets, it would be consistent to have a few marginal cuts to get down to neutral.
All right, Patrick, thank you so much, as always, for all of your insight. Patrick Armstrong, Chief Investment Officer at Plurimi, stays with us, and we'll talk currencies and yen shortly. We'll talk about the yen weakening to a level that may be prompting intervention by authorities in Tokyo. That's next, and this is Bloomberg. The conversations that matter, the insights you need. This is The Pulse. I'm Francine Lacqua here in London. Now let's talk yen, the currency touching the weakest in 9 months. That's as Japan's interest rate gap with the U.S. pushes the yen towards levels that saw authorities intervene. Now for more on this, still with us, Patrick Armstrong, Chief Investment Officer at Plurimi Wealth. Patrick, wow, I'm so glad. You're probably glad you're not BOJ governor right now.
Yeah, well, if I was BOJ governor, I would be getting rid of yield curve control pretty quickly because it's just a disconnect that's not going to work. When you've got every other central bank hiking rates up at 5%, real rates at 2.5% in different term structure in the United States, and you've got Japan with significantly negative real yields. The rest of the world's moved on from that. It's an untenable situation that you're going to have yield curve control and support the yen. So they're going to have to decide which one's going to break. I think they want to do this in a gradual phased manner, but I do think yield curve control will be gradually phased out.
Yeah, so I was going to ask you, this is not a question of if, right? It's a question of when.
It has to be, yeah. Unless the world changes and we go into a deep recession where the rest of the world gets into cutting interest rates towards zero again, you can't have negative real yields and capping things at 1%. The Bank of Japan already owns 51% of all Japanese bonds issued right now. So there comes a point where they're the only purchaser.
This is our big number of today, and it's basically just level of yen. So it's big because we're just on government watch on whether to see whether the policymakers intervene. So it's 105.07. Does this change how you invest in Japan at all?
Yen can really strengthen if the Bank of Japan does show a plan to get rid of yield curve control. But while it's in place, I think the yen just has to consistently weaken. So we don't have a short yen on right now, but I've got a significant short in 10-year Japanese bonds right now. So if you put them both on, you're just expecting that policy to continue until it breaks. But when it does break, I don't want to be short yen. So I've decided to play it through the bonds, which I think is a safer bet.
So you're not playing any of the companies in Japan, or
I've got some companies in Japan, but it's not driven so much by what the Bank of Japan's doing. It's driven by valuations. I've got an industrial company, Mitsubishi, in Japan, which is based on valuation and pretty reasonable margins there. So it's not driven by the Bank of Japan.
Overall, what's your favorite stock right now?
I think it may be Zoetis. It's had a really good run, so we talked about that in the pet care. That's just a stock that's continuing to grow, estimates getting revised higher. So unfortunately, all the stocks that have done really well this year are now getting to pretty expensive multiples, and Zoetis is getting into the high 20s on earnings. But that's a stock. I like the business maybe more than the stock at 190.
All right, Patrick, thanks so much. Patrick Armstrong there, Chief Investment Officer at Plurimi Wealth. Coming up, Bill Gross says stock and bond markets are overvalued and bullish investors have got it wrong. We get the PIMCO founder's outlook on rates and inflation. That's next, and this is Bloomberg. Rising concerns over China's recovery as the crisis deepens at property developer Country Garden, plus alarm bells ring in the country's shadow banking sector. Goldman predicts the Fed will start lowering interest rates by the end of next June, with a gradual quarterly pace of reductions from there on. Plus, the yen weakens through a key level against the dollar, hitting a 9-month low as traders watch for any signs of intervention by officials in Tokyo. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Let's have a look at what U.S. Steel is doing, beginning a formal review of strategic alternatives after receiving multiple unsolicited proposals. Now, if you look at what we've heard from them, they've rejected this approach as being unreasonable, but that approach was actually a 43% premium to the steelmakers' last close, which is why pre-market we're actually seeing U.S. Steel gaining some 21%. Now, again, this is an icon of American industry with roots stretching back over a century. And yesterday is when they had this cash and share bid, which values the company about $7.25 billion based on the closing price on Friday, which was a 43% premium. Now, the PIMCO founder and former chief investment officer Bill Gross says both stock and bond markets are overvalued and bullish investors have just got it wrong. Well, he spoke to Bloomberg about his outlook for markets and inflation.
I think there is a case for 3% inflation going forward, plus or minus, and I think if we got to that point, then the Fed would begin to consider stopping and maybe even lowering rates over the next year or so. But I do think that the 10-year at 4.15 now, you know, it is probably overvalued and has been overvalued for a long time in terms of a lower yield and too high a price. You know, if Fed funds actually came down to 2.5% or 3%. You know, the 10-year term premium, that is the spread between 10 years and Fed funds, typically has been about 135 basis points over a long period of time. So, you know, if you add 135 basis points to 2.5% or even 3% on Fed funds, you get to a point where we are now. And that suggests that all of the bulls on treasuries and on the 10-year and maybe even on the long bond, I think their arguments are a little misplaced. I think it's been overvalued for a long time, and we're going back to proper valuation on longer term notes and bonds.
But I mean, you understand better than anybody that relationship between what's going on with inflation and the Fed and how that sort of factors into some of these bullish calls. And those bull calls have really started to increase, not just because of the two reports that we got this week, Bill. If they do have it wrong here, kind of give us a sense here of why specifically.
Well, I think they got it wrong, first of all, because rates were so low because of quantitative easing and the fact that, you know, in some cases, the 5-year real yield was a minus 200 basis points, which sounds incredible, but it was a year and a half ago and is now a plus 200 basis points, so a 400 basis point switch in terms of real rates. So I think investors simply got overwhelmed with the fact that the Fed would stay low and stay low for a long time, and that inflation wouldn't pop its head out of the rabbit hole it has, and so now we're moving back into an old age world, I suppose, in which interest rates really are a sign of a healthy economy. And the way we have it now, the negative yield curve, and we've had that for 12 to 18 months, I suppose. A thriving economy, a thriving finance-based economy can't do well. Doesn't mean it goes down in the dust, but it can't do well if low-risk investments yield more than high-risk investments. And as you march out from the 30-day bill to the 30-year bond, you can see that you are better off yield-wise in terms of the 30-year bill or the 30-day bill. And so that's just a perverted yield curve, and it won't do well for the economy going forward.
We'll have the PIMCO co-founder Bill Gross. Now, that comes as economists at Goldman Sachs predict that the Federal Reserve will start lowering interest rates by the end of next June. The Wall Street Bank actually anticipates 25 basis point cuts per quarter, but expects no more hikes to come this year. Now, for more, we're joined by Bloomberg's Christine Aquino. Christine, treasuries are so interesting right now. What are you looking out for next?
Yeah, Francine, I mean, there's a big debate really that's brewing over the path of long end yields. I mean, Bill Gross is weighing in on that. And essentially, there is this consensus saying that I think there is this time now where longer end yields have been so low for a while. They're getting back to those more normal levels that we've seen over longer stretches of time. And, that term premium increase, which Bill Gross was alluding to, that's exactly what we're seeing now, right? Because the latest kind of ructions in the Treasury market, that's really been led by 10 and 30-year yields. That's what has driven the yield curve steepening. And remember, this yield curve steepening is essentially what a lot of the perpetrators of the yield curve theory are really fearful of, right? It's really not kind of the yield curve inversion that people should be afraid of. They say that it's the steepening that follows afterwards. And that's exactly what we're seeing now. And yeah, it really just seems like a process of longer end yields adjusting to the new reality of higher rates, perhaps higher inflation.
But so I know there was a big school of thought actually saying, look, what we're seeing is soft landing, and now it seems a bit more touch and go. When do we know what kind of economy we're left with?
Yeah, that is the big question, isn't it, Francine? And I think the problem with kind of determining the timing for the soft landing is, of course, all the policy lags that we're experiencing at the moment. Economists have estimated it's about a 2-quarter lag until we actually see the effects of whatever the Fed is doing at the moment. And we've kind of seen that with the way that inflation has kind of come down from the peaks that we saw last summer, right? But it took a little bit of time and a lot of kind of consistent messaging from the Fed to really get it below those very, very high levels. We're not a target yet at the moment, but we are now seeing the Fed kind of starting to shift its message to more of data dependence. And so, yeah, it is quite a tricky balance for them. And they could be in a situation where, a soft landing for a little bit could potentially very easily shift into something that's a little bit harder.
I mean, there's a brilliant quick take actually looking also at whether the Fed has ever accomplished this. And they said maybe arguably once in 1994, under Alan Greenspan. If you look at China, and this is the big structural concern or something ugly happening in China because of the data points we're getting, how does that impact Fed thinking?
Well, I mean, it's very much a big factor, Francine. Of course, they would say that, oh, they're not kind of making policy for anyone else in the rest of the world. They're just really looking at the U.S. But China's very much a big factor in that, right? Because, again, remember, China was meant to be this big positive growth story for the world economy at the start of 2023. It really isn't panning out. In fact, we're kind of going the other way. And now kind of issues in the property sector piling so much pressure on the Chinese government to deliver that stimulus. I mean, this is something, of course, that the Fed is probably going to want to be keeping an eye on because it will have such big implications for the world economy and therefore, how the U.S. moves forward from here.
Yeah, and of course, from that stems everything from, ECB policy to possibly BOJ. This is the other interesting one.
Yeah, absolutely, Francine. And yeah, it really creates a problem for some of these central banks that have been laggards in the policy tightening process, right? Because again, I mean, we've heard from Christine Lagarde and her colleagues over the summer. They're kind of shifting more into this data dependence mode, much like the Fed. And so I think the argument is that there's very limited time for the ECB to kind of deliver more rate hikes down the pipeline. I think the expectation is that they're going to deliver one more in September and then potentially follow the Fed and kind of doing that extended pause, because again, it's very hard for smaller central banks to go it alone when some of your bigger counterparts are kind of rethinking their next steps.
And this kind of changes everything. I mean, if you look at yield curve control for Bank of Japan, I guess it's a question of when they stop it. And you know, if you look at traders, are a little bit all over the place on that.
Yeah, absolutely, Francine. Because again, we've gotten so many mixed messages from the Bank of Japan. I mean, they did tweak that policy, but then very much immediately after, in the next week, right, they kind of stepped into the market to kind of control that rise in yields in reaction to their initial action. And so there's very much a sense in the Bank of Japan corner that, you know, they really don't like this rapid rise in yields. And even though they've kind of taken the baby step toward normalization, they really don't want to see that process unfold very rapidly.
Christine, thank you so much. Christina Keto there from our MLive team looking at some of the big market moves. Now, coming up, gas supply risks are mounting as Europe heads towards autumn. We'll discuss the outlook next, and this is Bloomberg.
In Hanover, if you're caught watering your lawn on a hot day, you can get a fine of 50,000 euros. Germany is adjusting to levels of heat it's simply unprepared for. Only 1 in 10 Germans has an air conditioner versus about 9 out of 10 households in the US. Last year, more than 8,000 people died in Germany due to excess heat. That's the third highest in all of Europe. The Health Ministry has rolled out its first ever heat protection plan, hoping to save thousands of lives every year. But it's vague, and execution, as ever, is a complex issue in Germany. The heat weighs on growth too. According to early research from Allianz, the heat wave this year may have shaved 0.6% off of global GDP. Why? Simply because people work more slowly, work less, and make more mistakes when it's hotter out. In Germany, if winter was about rationing gas, summer, increasingly, is about rationing water.
Bloomberg's Oliver Crook there looking at the impact of extreme heat in Germany. Now, gas supply for the winter months in the Northern Hemisphere is also at risk, with a potential strike by workers in Australia putting LNG shipments at risk. Let's go straight to our Bloomberg natural gas reporter, Anna Shiravaskaya. Anna, great to have you on the program. Look, this is a huge, huge deal. If you look at the current prospects for industrial action in Australia LNG facilities, how disruptive could that be for the rest of the world?
At the moment, we still don't know if the strike will go ahead. The next round of talk is scheduled for tomorrow. But if the industrial action does happen, it risks disrupting about 10% of global LNG supply. And while most of the customers for that Australian supply are in Asia, China, Japan, Thailand, Taiwan, if there is an intense competition for cargoes, for available supply, that risks raising prices in both basins, in the Pacific and in the Atlantic, and Europe and Asia will, as a result, compete for available supply.
So, Anna, what are some of the other factors that actually worrying the LNG market?
The attention is at the U.S. hurricane season. If there's any disruption to the Gulf Coast facilities, that could also it happened in the past, so it could also disrupt global supply at the time when the Northern Hemisphere is approaching, slowly but approaching the peak winter heating season demand. So attention will be on that disruption. And also there are some planned outages globally, such as in Russia, Trinidad, and actually more plants are going to be out for plant maintenance in Australia, and Egypt is curtailing its exports because of high domestic demand amid high temperatures.
I mean, that's a great wonder, but a little bit worrying, right? That you could have all of these like different points of tension everywhere in the world. Will it show up in bills for consumers?
Indeed, yeah, it's a global market. That's why effects around the world affect both regions. At the moment, prices in Europe are still much lower than they were at the peak last year, but still consumer bills are still elevated, resulting from that increased levels we saw last year, so both for households and industrial consumers. So if the current uptick in prices stays and there's actual disruption in supplies, there could be extreme market volatility and further price spikes, which could in the future translate into customer bills. So we're going to watch how long this market volatility lasts.
And you do some great reporting on it. How much do you have to look at the weather as well? Last year, we were definitely helped by this mild winter weather. Is it too early to find out what happens the next couple of months?
It's a bit too early to say. I think going into the autumn, we're going to watch forecasts for the winter. But if winter is cold in both Asia and Europe, that would result in elevated prices in both regions. So again, competition for LNG could be very intense this winter.
Yeah, you're going to be very busy in the winter. Thank you so much, our Bloomberg natural gas reporter, Anna Shiravitskaya. Coming up, as we lead up to the BRICS Leaders Summit in South Africa next week, we also discuss what to expect. We're live in Johannesburg next, and this is Bloomberg. The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, Argentinian Congressman Javier Milei is leading a crucial primary vote in a performance set to upend October's presidential race. Bloomberg's Manuela Tobias has the details.
Argentina witnessed an absolute upset on Sunday night's primary presidential election. Javier Milei, an outsider third-party libertarian candidate, took 30% of the votes, winning as the highest voted candidate in the race. He outpaced the opposition coalition, who had, two candidates competing for the nomination, and the incumbent party as well. He outscored everything that the polls were expecting, which were pegging him at around 20%, no more. And it is just an absolute surprise compared with, as well, what markets were expecting. Milei has been compared with Donald Trump and Jair Bolsonaro. He represents his own libertarian party. Within all of the different market scenarios, a Milei upset was the least desired by markets. So this is likely to be received with fear. Investors like his economic message of slashing public spending, but he has an aggressive style and lacks any sort of party structure that would allow him to get the changes that he needs to make in Congress, over the finish line. He also, we're expecting a sell-off, definitely in the parallel exchange rate that analysts say could be around 15-17%. We're also expecting bonds to drop lower on continued uncertainty and the expectation that this election could go to a second round. We have a general election in October, and that could go off to November now that this race has been divided in 3 parts. Manuela Tobias, Bloomberg News in Buenos Aires.
Well, that was Bloomberg's Argentina economy and government reporter Manuela Tobias. Now, South Africa's BRICS ambassador, Anil Suklal, says the group aims to promote the interests of the developing world and is not in competition with any other bloc. The BRICS nations will meet for their annual summit next week in Johannesburg. So for a full roundup of what's expected, let's get straight to our very own Jennifer Zabazaja. Jen, good morning. So what else did Suklal actually say?
Yeah, Fran, I mean, this is significant. Suklal has been a longtime diplomat here in South Africa. He is the Sherpa this year as South Africa is the chair of the BRICS Summit. So we're really looking forward to what he was going to say. What he said specifically and what he started his comments today was about what you just mentioned, that he said it was unfortunate that the narrative has really shifted, that BRICS is trying to replace any sort of bloc or is anti-Western. He actually did say South Africa does not have enemies, and really this idea of supporting the the Global South and giving the Global South more of an opportunity to have a voice and a seat at the table in some of these multilateral institutions. It is something that these countries have not had before, and he thinks it is time. And speaking specifically about expansion, because that is something we've been talking a lot about. Right there, you're seeing old video of the 5 leaders that had encompassed BRICS. Right now, there's still 5 leaders, but as we've reported, more than 24 countries have actually formally applied to be a part of BRICS. And what Suklal is saying is that they still haven't really zeroed in on what the guidelines are going to be for which countries will be added. And that is really the focus for him and the other Sherpas and sous Sherpas, because they are meant to prepare a report that will then be given to the heads of state to decide which countries will be added. And so he thinks that there may be some pronouncement next week. But what he did here in the guidelines that he was given by his foreign ministers and others was not to make this expansion an accelerated process. And so those were just a few of the comments that he is making here in our office today.
So, Jen, you also spoke to the chair of the BRICS Business Council, Bouzy Mabuza, earlier this morning. What did he tell you?
Yeah, Bouzy is the chair of the BRICS Business Council. This is the 10th year of the BRICS Business Council. So she talked a little bit about the significance of why this exists and what the benefit is, not just for South Africa, but for Africa as a whole with other BRICS nations. Take a listen.
We have trade, economic ties and agreements with Europe, with the US. The BRICS formation is not a trade agreement of any sort. It is a club of nations that have the same outlook in terms of how the world should look in terms of multilateral cooperation.
Do they, though? I mean, we're talking about Russia, India, China, South. I mean, they have very varied interests in terms of what the global, the global economy should look like and who should be superpowers, right?
Absolutely. Look, there may be differences, but the fact that the BRICS emerged from global South-South cooperation and an effort to ensure that we move hand in glove and support each other as we emerge, and these are emerging economies, of course, that have the ambition to grow their respective economies. China seems to be realizing that better than most. India has done fabulously well over the past few years. There are lessons there. There are opportunities for us to, in partnership, lift each other as we rise. So there may be differences here and there, but the fact that these nations do believe in a multipolar world, I believe is a good foundation for the engagements that we are having.
Yeah, so Fran, Bouzy there saying that the importance of South Africa and the rest of Africa's relationship with the West, with the EU and the US is, of course, important. But the goal here, at least with the Business Council, is to enhance the benefits that Africa gets in terms of trade and investment opportunities. We saw last week here in Johannesburg, the Chinese ambassador and the South African ambassador to China making a number of announcements about specific deals with China and South Africa. And so what Bouzy wanted to reiterate is that is what is of importance here, despite what the other rhetoric is at this point in time. And so the fair, the Business Council fair will be over the weekend. So we're hopefully expecting to see some more investment deals and intra-BRICS trade announcements announced.
Jennifer, thanks so much. Jennifer Zabazauja, their Africa correspondent, reporting from Johannesburg. Now, we're also keeping an eye on what's happening to U.S. Steel. Again, it started a review. It spurned a $7.25 billion bid. This means the offer actually represented a 43% premium to the steelmaker's last close on Friday. Pre-market 23% higher for U.S. Steel. Up next, Bloomberg Surveillance Early Edition.